Hello, welcome to another episode of Management Accounting. In this chapter, we will learn the behavior of fixed costs, variable costs, and mixed costs. It is important for managers to understand how costs behave in order to be able to predict them and to make correct decisions. Let us recall the definitions and behavior of variable and fixed costs. Remember, variable cost is a cost that changes in direct proportion to changes in the activity level. The activity level, also called the cost driver, causes the variable cost to increase proportionally. The driver may be number of units produced, or labor hours, or machine hours, or miles driven, or number of minutes taken on a mobile phone. Variable cost per unit, on the other hand, remains the same over the relevant range. Fixed costs remain the same even when the activity level changes within the relevant range. For example, your monthly rent is fixed and does not change when you spend weekends out and do not live there the whole month. Per unit fixed cost, on the other hand, goes down as the activity level goes up. This is because the total fixed cost gets spread over a larger number of units. For example, your rent bill will become half if you took a roommate in. Remember, costs are fixed or variable only over a given time period. For example, all costs can be variable in the really long run. There are some fixed costs that can be changed in a relatively short period. For example, how much you spend on advertisement in your company can change in a year, but how much depreciation will be charged on a big machine is a long-term decision and cannot be changed easily. Similarly, if the number of units is the activity base, then cost of direct material is a variable cost. But if number of direct labor hours is the activity base, then direct material may not always be variable. So here we have put up the pictures of total and unit variable costs. Notice that in the left picture we have added little baby steps to the straight red line. The yellow zigzag is really the way cost behaves. Each time you make a pizza, total cost goes up by $1. So cost of cheese for one pizza is $1, for two pizzas it's $2, and so on. But the red line is an average or linear approximation of the yellow lines. On the right side, we have added a kink at the end of the red line to show the true cost behavior. We assume that the company will continue to buy cheese at $1 per pizza, but it is quite possible that if the company buys huge quantities of cheese, they may get a quantity discount and per unit cost may come down a little bit. So the straight line we have worked with so far is again a linear approximation of the true cost behavior. So here, just to refresh your memory about fixed costs, we have put up the total fixed cost and per unit fixed cost pictures. We assume that total monthly rent is the same within the relevant range, but what about outside that range? At some point, we would need to rent another room or buy another oven or hire another cook, and the fixed cost would jump to a new higher level. Stay there until the place needs another stretching and a third room or another delivery car or another delivery boy is needed. So a straight line is just a linear approximation of the true cost function that behaves in steps. We will visit this point and the relevant range in a little bit. There are some costs in real life that are neither purely variable nor totally fixed. For example, if you rent a car, you pay a fixed amount per day, but after a certain mileage, you might have to pay extra for each mile traveled over the limit. Similarly, your cell phone bill has a monthly rate for usage, but if you exceed the number of minutes permitted, you will pay extra for each minute used over the limit. Many salary contracts are also examples of mixed costs. Sales staff is paid a fixed salary per month plus a commission on each unit sold. So, our job here is to separate the fixed cost and the variable cost from the mixed cost. Before we learn how, let us understand why. This is because it is much easier to predict the behavior of variable and fixed costs. For example, if I knew a cost to be variable, then I can be sure that it will double if I double my production. On the other hand, if I know a cost to be fixed, then I can be sure that it will not change at all, at least within the relevant range. There are some other things to note before we move further. Remember, the goal of the whole exercise is to be able to predict future costs accurately. So if the costs are misclassified as fixed or variable costs, then cost prediction will also be inaccurate. Since we are working with linear costs, we will be able to work with only one driver. Suppose cost of making a pizza is affected by number of pizzas made and also by the price at which raw materials are available in the market. But we will have to choose only one of the two drivers, and our prediction will be as good as the choice of our driver or our activity base. The choice of time period for which cost function is estimated is also important. If we are predicting cost for 1 year, most of our assumptions about relevant range might work. But if we are predicting costs for, say, next 5 years, then some fixed costs might become variable and cost function and prediction will be inaccurate. Lastly, if you are operating too close to the relevant range, your costs are more likely to change. But if you are, say, teaching only 10 students in a classroom with 60 students capacity, you can safely assume rent to be a fixed cost, not about to change anytime soon. So, even though calculations are necessary to solve problems, picking the correct driver and being aware of time and data limitations is more important to estimate a good cost function. So, we will assume that an equation of the following form can be used to express the relationship between mixed costs and the level of activity chosen. In this equation, y is the total cost of making a pizza, a is the total fixed cost, b is the variable cost per unit, and x is the number of pizzas made or any other independent variable chosen. In other words, we assume that number of pizzas made cause the total cost to move up or down. So, number of pizzas made, or x, is our independent variable. The total cost is dependent on it. You might have seen this equation as intercept and slope of a line. It is exactly the same idea used in the context of cost. So now the job is to identify the A and the B in our cost equation, or in other words, to separate the fixed from the variable. There are many methods used by companies to achieve this goal. Some methods are quantitative and are based on calculations, while others are based on engineering estimates, accountants' estimates, or are more quick and dirty, like simply plotting the data and looking for linearity. The first quantitative method used to separate fixed and variable costs is good for those companies that have a long record of historical data and their costs have a linear relationship between dependent and independent variable. In this method, we first choose the cost to be estimated, or in other words, our dependent variable y. Next, we pick the cost driver or the best independent variable x. In most problems, both these are given to you. You just have to be careful about which one is causing which. I mean, be clear on which is the cause and which is the effect. Next, find the highest and lowest activity levels from the available data. Next, identify the total cost associated with the chosen high and the low activity point. Next, take the difference between the two costs and divide it by the difference in the high and low activity levels. The result is your variable cost per unit. Now, take the total cost at either of the two activity levels, either high or low, and deduct total variable costs from total costs. The leftover number will be your fixed cost. Now, you can write fixed cost as A and unit variable cost as B. Let's look at one example. Suppose we have 5 months of data available for our pizza company. First thing to figure out is the correct y and x. Note that number of pizzas made cause the cost to move. So number of pizzas is the cause, or x, and total cost is the effect, or y, and not the other way around. Next, single out the highest and the lowest number of pizzas made from the list. The lowest is 4,000 and the highest, as you can see, is 12,000 pizzas. Now, write down the cost at 4,000 and 12,000 pizza levels. You will have 7,500 and 13,500 for the two levels. Now, subtract low activity from high activity to get the rate of change on both x and y. So roughly speaking, when production changes by 8,000 units, cost change by 6,000. How much will cost change if production changed by 1 unit? We will divide 6,000 by 8,000 to get the rate of change. We see that each time production changes by a unit, cost changes by 75 cents. This is our per unit variable cost. What is the total variable cost at any level of production? It should be per unit variable cost times the number of units made, right? Now you can take the total cost at either the high point or the low point and deduct total variable cost to get to total fixed cost. Let's try the high level. At 12,000 pizzas, total cost is given to us at 13,500. Since variable cost is 75 cents a unit, for 12,000 pizzas, it would be 12,000 times 0.75 equal to 9,000. Are you with me so far? If we subtract total variable cost of $9,000 from total cost of $13,500, we will have $4,500 of fixed cost. That is our intercept or our A. Now we can write our cost function as y is equal to 4,500 plus 0.75x. If the company is planning on making 11,000 pizzas next month, what is your best cost estimate? It's easy. You put in 11,000 in place of x and solve for y. Your best cost estimate should be 12,750 for 11,000 pizzas. Are you fine so far? Let's look at a slightly harder problem. Here you are given a hospital with a mixed cost of $32 per occupied bed per day with a maximum capacity of 450 beds each day. Here you need to write the cost equation using the high-low method. Remember, you need only 2 data points in high-low to come up with a cost equation. If you look carefully, you are given 2 points already. One is at 80% occupancy and the other is at 60% occupancy. Figure out the cost at both these levels and then simply apply the high-low method. Let us try to calculate the operating capacity at 80%. Let's try to calculate the operating cost at 80% capacity since the operating cost at low point of 60% is already given to us. So, monthly operating cost at 80% occupancy would be 450 beds times 80 times 30, which is the number of days, times the cost, which is $32 per day. Does that make sense? Now, we have the high point cost and we can subtract the low point cost given to us in the problem to get to the difference. So, we will have 18,900 as the difference in cost, which is our change in Y. Now, we need to get the difference in high and low activity to get the difference or change in our X variable or activity or driver or independent variable, whatever you may prefer to call it. At 80%, you had 10,800 bed days, and at 60%, you had 8,100 bed days, and the change is 2,700 bed days. Now it is easy. We divide change in Y by change in X to get our slope or variable cost per unit. In this case, variable cost per bed day would turn out to be $7 per bed day. So the setup is kind of tricky, but the solution is easy. Now, we can subtract our total variable cost at either of these 2 points to get to fixed cost. Let's use the high point when total costs were $345,600. If we subtract total variable cost at 80% level of occupancy, we will get fixed costs of $270,000. You can check this by subtracting the total variable cost at 60% level of occupancy from the low point total cost given to us at $326,700 in the problem, and check again that the fixed cost will come to $270,000. So our cost equation here is $270,000 plus 7x. The question says, what is the total estimated cost if the hospital experiences 100% occupancy rate? Now that you have the equation for total estimated cost, you just have to put in x and solve. But be careful, x here is number of bed days in a month. So it should be 450 times 100% times 30 times 7, and not just 450 times 7. The rest of the calculation is easy. I hope that you noticed that high-low method uses only 2 points from the entire data, highest and lowest, and throws away the rest. If the highest and or the lowest point are outliers, meaning extraordinary circumstances not likely to repeat themselves, then the cost estimation will not be accurate. Regression method is a statistical technique that measures the average change in the dependent variable associated with a unit change in the independent variable. The formula used in regression, also called least squares method, is complex, but software is easily available to fit a regression line using all the data points. This method is most complex but provides the most accurate results because it leaves no room for subjective judgment. Under this method, we plot all the data on a graph and measure the distance between the data points and estimated cost function. Then we square the distances to omit any negative signs. Then we total all the distances, also called the residual errors, and pick the line that has the minimum sum of the errors squared. The line that fits the data best during this criteria, using this criteria, is the best fit for this data. The measure used to show the goodness of fit of any x and y variable pair is called R-square. So, if you are given a choice of independent variables and you have to pick which one is best, you would pick the one with the highest R-square since it fits the data better than all other drivers. Here is a simple regression equation. Read it carefully and draw a picture if necessary. You will realize that you are actually given 2 points to draw a line here. One is the high point of 1,000 units and $9,600, and the second point is 0 units and $600. Do you see that? When they say that the regression line passes through y-axis at $600, it means that at 0 units, cost is 600, which tells you that constant or fixed cost is 600 and variable cost must be $9,000, meaning $9 per unit. So our answer should be A. Notice that it actually had nothing to do with the regression method as such, just a choice of words I wanted to present to you. Let us look at one more regression problem. You are given a bunch of regression related numbers and you have to learn to recognize what each one is. First question is asking about fixed cost. You need to know that in a regression equation, the fixed cost is the constant or the A part of the equation, y equal to a plus bx. Second question is about per unit variable cost, which is the coefficient or the b in our y equal to a plus bx equation. The third question just wants you to combine a and b and write an equation of the form y equal to a plus bx. Easy. The final question is about coefficient of determination or R square, which tells you how good is the relationship between x and y. The closer this number is to 1, the better is the goodness of fit between x and y. If you want, you can check your answers. So here we have answers to all our four questions. Our fixed cost is 5,800. Our variable cost is 1.902. As a result, our cost equation is y equal to 5,800 plus 1.902x. Finally, the coefficient of determination, that is R square, is almost 90%, which is a very high goodness of fit because it says that it explains the relationship between y and x and y quite well. As we discussed before, costs in real life do not guarantee to always fall on a straight line. There can be many reasons why this is not so. One is that companies making a very large quantity of a product can make them cheaper due to lesser fixed cost per unit, or they can negotiate a better price for raw material or labor. Another reason is that some costs are step costs by nature. This means that they do not move with each unit produced, but move with each setup or production run or each batch. So they take tiny little steps upwards. One more reason for costs, especially labor costs, to be non-linear is learning curves. Since we are dealing with human beings, we have to account for the fact that human brain learns with experience and learns to do things better and faster constantly. So, if labor takes lesser and lesser time to make a unit, then total variable costs cannot be linear. We will look at two types of learning curve models here. The first model is called the cumulative average time model. As its name suggests, this model assumes that the average total time taken to make X units goes down by a certain rate. The incremental unit time model, again, true to its name, assumes that the time taken by the next unit goes down by a certain rate. We can use either of these two models to predict future labor costs. So here we have an example to show you the two learning curve models in action. Under the cumulative average method, the time taken by first unit is 40 minutes and the time taken by the second unit is 32 minutes. So the cumulative average time to make 2 units will be 40 plus 32, that's 72 divided by 2 equal to 36 minutes. So cumulative average time is coming down from 40 minutes to 36 minutes, showing a learning curve of 90% on average. Under the incremental method, first unit takes 40 minutes and the second unit takes 32. So cost comes down to 80% of the first unit, showing an showing an 80% learning curve. You can use the formula and the factors given to solve the problem, but it is always better to understand the methods and to learn how to solve them without the help of the calculators. So let's look at the solutions. So in part A, we use the cumulative average model that shows a 90% learning curve. Part B wants to know the average time taken to make 32 units. You can use the formula, noticing that A is the time taken by the first unit and B is the percentage of learning curve or the rate of change. X and Y, as before, are independent and dependent variable respectively. If you decide to do it manually, notice that we are doubling the units at each step. We go from 1 unit to 2, 2 to 4, 4 to 8, 8 to 16, 16 to 32, and so on. The second thing to be careful about is that we are using the numbers in the cumulative average column and not in the first column of minutes, something that we will do in the incremental model. So the average time taken by 2 units is 90% of first, 4 units is 90% of 2, 8 units is 90% of 4, and so on. The third thing to notice here is that the cumulative average model gives you the average time taken by each unit and not the total time taken by 2 units. So when you get to 32 units, time taken is equal to 23.6 minutes. Since we started with the first unit taking 40 minutes, it cannot be that 32 units are taking a total of the 23.6 minutes. So please remember that this is time taken by X units on an average. So the total time taken by X units will be X times 23.6 minutes. Finally, don't worry about small differences in numbers. If you work with more decimals than 2, you might get a slightly different answer than here, but it will not be very significant. Now, let's look at the incremental method. Here, the correct interpretation of the factor given is that the xth unit takes y time with A as before, that is the time taken by the first unit. If you go back to part A solution, you will notice that this time we are working with the first column of minutes taken by each unit and not with the total time or with the cumulative average time. So first unit takes 40 minutes, second unit takes 32 minutes, showing an 80% learning curve. Now fourth unit will take 80% of second, eighth will take 80% of fourth, and so on. So the 32nd unit will take 13.11 minutes. Notice that the number here says 32nd unit, not 32 units. So under incremental method, you will be asked to calculate the time taken by any one unit, but in cumulative average method, you will be asked to calculate the total time taken by 32 units or any other number of units. Please be careful of the question asked and you will always be correct. Happy solving!